What we're going to talk about today are offset accounts. There's a lot of confusion out there to what an offset account really is and how it works. It's actually very, very simple. The banks would like you to have an offset account, and there's a reason for that. I'm going to talk about that in a minute. So as an example, if you have a $400,000 loan and you have $200,000 sitting in your offset account, that means you only pay the interest on the $200,000. Now the money that's in the offset account is like a savings account. So what they say is, okay, you owe $400,000, but because it's linked, we're going to take that off that. We're only going to charge the interest on the $200,000. So if you had $100,000 in the offset account, they're only going to charge you interest on $300,000. And if you had the whole $400,000 in the offset account, you'd only pay interest on you wouldn't pay any interest at all. Very clever. Now, offset accounts have their purpose. If you have a home loan, it's actually psychologically, in my opinion, better to actually have that money straight on the loan. Because most Australians, when they see that money in an offset account, their view is, that's my money, and I want to be able to spend it whenever I want to. And that's okay, because it is your money. However, if that money is sitting on your loan, the chances of you taking that money back out are slimmer. So the key that we encourage is to get rid of your home loan. Home loans, personal loans, credit cards, car loans, they're all bad debt. We need you to get rid of them as fast as you possibly can. So if you have a home loan itself, no investment property, an offset account is a good idea, providing you leave the money in it. I personally think you should be better off putting the money straight towards the home loan because it's the same thing. However, there's a bit of a difference when you buy an investment property. So if you have an investment property and the investment loan is $400,000 and you have $200,000 in the offset account, you pay interest on the $200,000, which is brilliant. However, if you decide to take that $200,000 out and buy something personal with it, you can do that at any point in time. But the original loan amount is $400,000. And as we know with investment property, the interest on that $400,000 is what you can claim in your tax return. So if you take the money out of the offset account, the interest on the normal account is back to normal and you can claim the whole lot in your tax deduction. However, if this was personal and you actually had that money sitting on the home loan, so if you had the $200,000 and you took it straight off the $400,000 loan and it's your investment property and you then draw that back out, that money is no longer tax deductible. You may think it is because this is against your investment property. It's a trap you need to be very mindful of. So we can help you through all of this. So have a look at our website, eqc.com.au. Give us a call, 1800 263 980, or check us out on Facebook. Thank you.